Welcome back to the rest of chapter 10. In this video, I will be getting my hair done while reading to you. As you can see. All right, so we ended on, she was talking about whether or not you should hold a position or not hold a position overnight. So we're going to jump right into it. All right, to hold overnight or not to hold overnight. Swing trades necessitate holding positions overnight. The preceding explanation of gaps explains why holding stocks overnight can make you yell with happiness or pass out cold. It all depends on your personal risk tolerance levels. One camp of day traders would sooner stop breathing than hold a position overnight. Other traders make fine profits on overnight plays. I belong to the latter camp. I've made money buying stock in 5 minutes, or buying a stock 5 minutes before the market closes and selling it the next morning just seconds after it opens. Dissenters argue that holding a stock overnight exposes you to risk. Occasionally, Mr. Big Shot analyst from Mega Brokerage has to earn his pay by downgrading industries and or stocks. Of course, if Mr. Shot downgrades a stock you're holding after the market closes for the day, the stock will likely open much lower the following morning. If you own a large position in that downgrade, the loss can dent your account. One of my friends, bless him, has an unfortunate flair for buying stocks that get downgraded overnight. I somehow escape with profits that far outweigh my occasional calamities. Here's how I do it. I hold long stocks overnight. Emphasis on long. That reside in an industry group engaged in a healthy uptrend, that represent the leaders of their industry group. When the overall market is bullish, when the stock is in a strong uptrend, optimally closing at or near its high for the day, when it's the stock's first or second day, not the third day, up from a breakout, I take home small positions, if any, of these so much as breathe funny before the close. I close the trade or reduce my share size. If the stock gaps open the next morning, I sell at least half of my position. If you cultivate the knack of holding overnight and making money consistently, go for it. If you attract downgrades like ugly on an ape, leave overnights alone. Nitty-gritty stuff about day trading. Early on, I suggested opening 2 trading accounts, one for position and one for swing trades, the other for momentum and day trades. I also stressed that if you did decide to manage dual accounts, it's very important to keep the 2 separate. Goals and risk-reward ratios differ between position and swing trades, day trades, momentum trades, and scalping plays. Time frames dictate those ratios. Position and swing trades lean a little more towards investment objectives, particularly with position trades. You focus mostly on the individual stock's progress. If Mother Market slips into a rotten mood for a morning or afternoon, as long as your stop loss isn't violated, the trade remains intact. Intraday trades, however, involve abbreviated time frames. Traders superimpose every nuance of market mood onto open positions. When Mother Market frowns for even 10 minutes, she causes many stocks to join her bad mood. As the saying goes, when mama ain't happy, ain't nobody happy. In a swing trade, a 65-cent drop may not cause concern. In a day trade, it could easily stop you out. In a swing or position trade, your stop might be as far as $1.50 away from your entry point. In a day trade, depending on the stock's volatility, your initial stop price will reside less than a point from your entry price. As mentioned before, potential rewards should outweigh risks. In position and swing trades, you look for multiple point profits. In day trades, you may offer out or sell at a point or even half a point profit. Momentum and scalping plays grab fractions of points. Day trading demands keen concentration. You focus intensely on chart patterns while monitoring market internals. The heightened pace of day trading encourages many new traders to overtrade. They jump at any stock with a decent setup and end up stockpiling stocks into their account. Suddenly, they find themselves in panic city. I've been there. When I started trading, I crammed 10 or 20 positions into my account at one time. Trouble was, I couldn't keep track of all of them. Instead of trading to trade well, I became a troubleshooter. and I shot big holes in my bottom line at the same time. Overtrading leads novice traders to forget their goal, to protect their principal and cherry pick the best trades. Instead, they jump in and out of positions far more than necessary, stacking up losses, slippage, and commissions. The losses goad them into overtrading even more, which attracts more losses. You get the picture. Experienced traders take their time. They pluck out the best trades and ignore the others. They also stop trading when odds go against them. Hot tip, remember, when stocks gap open higher than they closed the prior evening, specialists and market makers have to take the other side of the trade. They must short those rocketing stocks. How do you think they cover those short positions with a profit? By waiting until the steam escapes from the initial run-up, then bringing the stocks down hard. Does your stock waltz or jitterbug? When you start day trading, a good prevention against ulcers is to learn your target modus operandi. That way, when it pulls back, and it was like 5 minutes of me trying to figure out one fucking phrase. Anyway, that way, when it pulls back an entire point, you won't faint at your desk. Just as they do on daily and longer term charts, stocks draw trends, continuation patterns, and pullbacks or retracement patterns on intraday charts. The price range of the pullbacks depends on the stock's daily price range and intraday volatility. This is illustrated in figure 10-5. Remember, pullbacks on intraday charts represent profit taking just as they do on daily charts. Remember that each stock has its own personality. Medium to mild-mannered stocks average 25, 50 to 75 cent intraday pullbacks on average. More volatile issues fall back a point even more. Figure 10-5. Moving right along, when you target a day trading stock, survey its intraday price action for the previous 3 days. Calculate the average pullback. Knowing what to expect helps you from exiting positions too soon. It also tells you how much room to give your trailing stop. Hot tip, if your trading software includes the ATR or average true range indicator, you can determine what the average price range of your stock is per day over the default period, usually 14 days. If your target stock's ATR is 88 cents and by the afternoon session it's risen on the day by 80 cents, there's not much room for additional upside action. Where to place your stop loss orders. Stop placement can make for heated discussions. There is no one stop fits all answer. As an old trading coach of mine used to say, where you put your stop depends on your tolerance for pain. It's true. Those who have a high tolerance for risk will place their stops farther away from the trading action. They don't get stopped out as often as their risk-averse buddies, and their rewards can be large. Still, when they do get stopped out, the losses are acute. Traders with low risk tolerance will keep their stops tighter to lessen the Maalox moments. They experience their own variety of pain. However, because stops set too tight to price result in trades stopped out too soon. The constant re-entries and attempts to make back the string of small losses can cause overtrading. An overall guideline: set your stop orders far away from your entry price to give the trade time and space to evolve, and close enough to prevent damaging drawdowns. After entering a trade, place your initial stop loss 10 to 50 cents below the day's low, or if that's too far away, put it 10 to 30 cents below support on a 15-minute chart, 10 to 50 cents above if you're shorting. Again, use common sense. If you're trading a stock priced at $115 per share with an average daily range of $4, you'll have to give the stop more room. A $20 stock with a 1-point average price range will probably be all right with a 30-cent stop. Hot tip. Your broker, whether an online discount broker or direct access, should offer automatic trailing stop orders. This makes the stop process easy. Measure your stock's average pullback range on your intraday time frame during the last 3 days. Then enter your trailing stop order to fit that range and add on a few extra cents so you don't get whipsawed. Good idea. As the stock moves higher towards your profit target, tighten the trailing stop amount so you reap the most profits if possible. Of course, you'll check support and resistance to make your final decision. Once the stock makes a new high, adjust your stop loss up to the current price, minus the pullback average range. Here's an example of moving your stop up with the price move to preserve your profits. Suppose your entry point on Simple Software is $20.25. You place your initial stop loss at $19.70. You've designated Simple's pullback range to be 40 cents. When and if Simple climbs to $20.90 or thereabout, you move your stop to $20.50 or 40 cents below the current price. Each time the stock makes a new high on the day, adjust your trailing stop order to 40 cents beneath the high price. Now, if you see Simple closing in on resistance, depending on the overall strength of the market, time of day, and whether or not your stock is losing steam, you may want to take partial or all profits instead of waiting to be taken out by your stop order. Remember, once you establish your stop point, you may move it up, but never down. Day trading setups, what you're looking for. Earlier in the chapter, you noted the illustrations and learned the two classic setups for entering swing trades and day trades: breakouts from consolidations and breakouts from pullbacks. As I mentioned then, if you trade only these two setups while combining signals from candles, volume, moving averages, a momentum indicator, and top-down criteria, you can develop a successful trading career. For those who want more adventure, we'll look at additional setups and fine-tune the entries. Start by doing your homework. Analyze the previous day's price movement. It tells you where and when you can or should not enter in the case of a gap opening today. A given for the following plays: moving averages play a role in day trading as well as longer-term plays. I use the 20-period moving average and 200 MA on all intraday charts because they're powerful support and resistance. For scalping the mega quick plays, I use 1-minute charts and add the 10 MA. As you develop your own trading style, you may add a 100 MA and or 50 MA, or change your MAs to exponential if your trading software offers that option. Please remember that you'll have better odds with your intraday long plays if the stock's current price rides above the 20-day MA on a daily chart and the 20-period MA on the intraday time frame you've targeted. The 200 MA is particularly powerful on 15-minute charts. If it's above your stock's current price and ready to bop it on the head, it exerts pressure as the stock tries to rise. Imagine you're in a swimming pool treading water. A bully standing next to you keeps dunking you. Every time you come up to gasp for air, he puts his beefy hand on your head and pushes you back under. The 200 MA resembles the bully. Yes, of course, the stock can rise through the 200 MA and keep climbing. It's just that playing stocks with the 200 MA overhead, other MAs overhead can also push a stock underwater, reduces your odds of winning. Buy setup 1. Find a target stock that's breaking out of a base or already trading in an uptrend on its daily chart. For the last 2 or 3 days, it's pulling back. Yesterday, assuming you'll enter the trade today, the stock closed in a narrow range doji with the low resting on the rising 200-day MA. Today, it opens at or near within 35 cents yesterday's close. If it gaps open slightly, it fills the gap quickly. It reverses and moves back, breaking the morning high. Buy at the break above the daily chart's doji high price. If conditions say go, take an early initial lot on the entry day and then add it over the doji high. This trade works best when captured in the morning session. Alternative, if the market environment suggests the stock can move higher in the afternoon session and risk-reward analysis is favorable, take half of your profits near the end of the trading day and hold the second portion as a swing trade. And figure 10-6 is showing the buy setup number 1. Hot tip: look for stocks that close at the high of the day on strong volume. These make the strongest setups for a potential entry the following day. Figure 10-7 shows a daily chart of consolidated Edison or ED pulling back in an early uptrend, making higher lows. In 2 instances, the pullback days resulted in narrow range doji, meaning the day opened and closed at nearly the same price, and the range between the intraday highs and lows remained relatively small. These doji days act as pressure cookers. When the next day is positive, it often offers good long intraday trade opportunities. The 5-minute chart of ED shown in figure 10-8 shows buy setup number 1 in action. By the way, May 10th was Fed Day and the FOMC announcement. You can see how even a calm stock like ED dropped hard on the news of an interest rate hike, even if only for a few minutes. If you were day trading on this day, you knew to exit your positions before 2:15, or at least to have a good stop order established. Figure 10-7. Right, and this is figure 10-8. This part's hard to do. All right, figure 10-8. The 5-minute chart of consolidation ED shows a good example of setup 1, climbing in an early uptrend on its daily chart. Yesterday it closed in a doji that rested on the rising 20-day MA. Today, May 10th, ED opened with yesterday's close. You could have bought on the first bar up or second candle from open, or you could have waited for the reversal period and the bounce off the 20 MA. To answer the question you were thinking, which is, isn't volume low? It's not so much that ED's volume is low during the first part of the day. It's rather that the second half, as ED climbs, is unnaturally high. You wouldn't have seen that if we could have stretched the chart back a few days. Day traders would have made a nice profit of about 70 cents on this trade and could have held half of the position overnight. As the stock closed on the high of the day, on the very high volume, and continued higher to the next day. Note how the stock rolled over on the FOMC announcement. If you were day trading this or any other stock, you wisely took half or all of your profits before the announcement. Buy setup 2. Once again, find a target stock in an uptrend. Yesterday was positive and the stock closed near its high on the daily chart. A consolidation pattern into the close is preferable. Today, on a 5-minute chart, the stock opened at or near yesterday's close. It may move slightly to the upside, but then, perhaps during the 9:45 a.m. to 10:15 a.m. reversal period, it drops to a low on low volume and holds on previously established support. Drop should be no more than 1.5% of stock price. A narrow range bar called a bottoming bar shows the mini downtrend may reverse. Next, a reversal candle confirms a reversal. But when the reversal candle trades 1 to 10 cents above the bottoming bar, don't chase it. Place your stop 10 to 40 cents, adjust to suit under entry point. When the price reaches the high set earlier in the morning, raise your stop. The 5-minute chart of Monster Worldwide Inc. in figure 10-10 displays buy setup 2 in action. Since this is a medium risk setup, I take all profits on this momentum trade once it shows signs of buying exhaustion. Remember, in all of these entries, the top-down criteria is given. Buy setup 3. This setup is easy to spot, trader friendly and reliable as long as Mother Market is in a cheerful mood in the afternoon session. Target a stock in a long range uptrend. Yesterday isn't that important, but today is. Today the stock must be positive and moving up, with plenty of upside potential available and no nearby resistance present on a daily chart. On a 5-minute chart, it reaches a high in the morning session, then pulls back in an orderly fashion into the lunchtime period, preferably more than 50 cents or 1.5% of its price. The stock straight lines through lunch or forms an orderly consolidation pattern just above or below its 20-period MA. After 1:30 p.m., you may notice many candlesticks are positive, closing on their highs. Soon after, with all systems a go, the stock breaks out and climbs into an afternoon rally. Hot tip. On muscular days when the market trends up and your already uptrending stock goes along for the ride, some traders buy when the stock rises above the 20-period MA on a 5 or 15-minute chart and sell if a 5 or 15-minute candle closes below that MA. When you see volume coming into the consolidation, buy an initial small portion while the stock is still trading sideways, and place your stop a few cents under consolidation lows. If your stock is trading under its 20-period MA on a 5-minute chart, you may want to wait until it closes a 5-minute candle above it. If the breakout follows through, add to your position, take profits before the close. This one usually delivers nice take-home pay. Figure 10-12 shows buy setup 4 in action on a 5-minute chart of Phelp Dodge. Quick level 2 review and intraday trading tactics. You can make money on position and swing trades using only an online broker. To profit safely and consistently on intraday trades and scalping plays, however, it's advantageous to have access to a level 2 order entry system. Since you graduated from boot camp, you already have a good idea of how level 2 works. Let's brush up a bit. When you've targeted a stock to trade, first check your level 2 screen for the spread between the inside bid and ask. As a rule, trade stocks with a spread of 3 cents or less. Why do you trade only stocks with a 3-cent spread or less? To narrow your risk. Say the stock is trading at the offer and not between the bid and offer. That means buyers will pay the inside offer or market price for the stock. You'll see that on your time and sell screen. Before you buy, think. Because I have to pay full price for the stock, if it turns against me the second I enter, where can I get out? Your answer is the inside bid. The most desirable spread is a penny. If the spread widens to 5 cents or more, your risk increases. That means if the stock turns against you as soon as you buy the stock, and it happens, you'll have to sell at the market or the bid if you're lucky. Your immediate loss on a 1,000 share lot, including commissions, could total $100 in a hurry. Do that 5 times a day, and you've got a $500 loss that you have to make up. If you do the math for a weekly run, you get the point. Next, with listed stocks, if you see block trades going off, 10,000 shares, trade towards size. Watch your time and sell screen. Are the biggest lot sizes traded on upticks or downticks? Please go with the trend here. If the institutions or big investors are buying, that's what you do also. If they're shorting and your setup agrees with that, go for it. If they're shorting and your setup agrees with that, go for it. Once again, if the stock is trending up quietly and the spread is 3 cents, you can attempt to split the bid and ask by placing a limit order for the price between. Example, Igloo ice cream is trading at $27 by $27.03. Issue your limit buy order at $27.02. You can sell the same way as long as the stock is trading quietly and you are not rushing to get out. Use the time and sell screen as a storytelling device. Say you enter a stock on an early morning breakout, it consolidates into the 9:45 a.m. reversal. At 10:20 a.m., it shoots through resistance again. If time and sells shows strong volume streaming into the buy side and your chart agrees, you can add to your position. Conversely, say you're in a profitable trade and the price is nearing resistance. The market is overbought and you see size selling off the time and sell screen. Consider taking profits. Remember, the trades in this discussion are short, intraday trades. Level 2 screens for volatile stocks change in nanoseconds. Once you're in an intraday trade, refer only to the chart. If you sit and watch the level 2 screen, intraday gyrations play games with your head and cause level 2 fake out. You'll jump out of your trade long before your profit objective. More and more stocks have widening spreads between the inside bid and the ask. You must be extremely careful when you trade these stocks on an intraday basis. What happens if the market turns against you before your stock has a chance to rise? Ouch. Say you lift or buy the offer at $20.10. The bid is $20. If the stock suddenly heads south, the market makers will drop the bid even lower. Prices get trampled as traders rush for the door, and you may suffer acute pain trying to get out of your position. Wise traders avoid these stocks. Okay, back to the good stuff. Say the perfect setup for your target stock presents itself. If the stock moves slowly enough, you can buy on the bid. Post a limit buy order for the inside bid price. Before you place any order, though, please become proficient with your order entry system. When I started, systems sprang from their incubators directly into the hands of the guinea pigs who ordered them. We downloaded the software and that was it. Limited training and support was available. My total training, this was 10 years ago, on my level 2 order entry system consisted of a man's voice on the other end of the telephone. He said, "Okay, honey, got the program downloaded. Good girl. See that buy button? When you want to buy something, click on it. Buy." To this day, I can only whisper how much money I lost learning how to trade by the trial and error method. Please learn from my mistakes. Study your order entry system and do plenty of dry runs before you trade with real money. Pre-market and after-hour trading scene. Many brokers offer pre-market and after-hours trading. The pre-market opens at 8 a.m. up to the market open. Some brokers allow after-hours trading up to 8 p.m. If you're a new trader, I suggest you avoid the pre- and post-market sessions. If you must take a pre- or post-market trade, please be aware of the following. The spread between the bid and ask can resemble the Grand Canyon. Number 2. Seasoned professionals reign over pre- and post-market sessions. They may have access to prices available in other markets that puts individual traders at a disadvantage. Number 3. Pre- and post-market sessions tend to be illiquid. Breaking news, earnings announcements, and chat room sessions can add to extended market volatility in the targeted stocks. Number 4. Low liquidity and high volatility equals high risk. Number 5. Just because a stock trades higher in the after-hours session, it does not mean it will open at the same price the next morning. Exaggerated price movements during these sessions may not sustain momentum. Lastly, you must place limit orders in these sessions. No market orders are taken. Your order may or may not be filled. Keeping all the above points in mind, I have bought limited positions in post-market sessions that looked attractive to me in after-hours research. I trade with caution, however, and remain aware of trade limitations. The ultimate day trading scene. If you've toughed out the journey thus far, you're on your way to a successful trading career. As a day trader, you're similar to the ringleader in a 3-ring circus. You outthink tigers and lions, specialists and market makers, show the clowns from the tent when they act too rambunctious, exit stocks that misbehave, hold the net for trapeze artists adhering to stops under open positions, and at the same time, direct the remainder of the cast, monitor market internals and industry indices. This is a big role to fill. One effective way to set up your screen. 2 monitors hooked to the same computer is better. Is to position your 5-minute, 15-minute, 60-minute, and daily charts. Most intraday traders rely on the 5-minute chart as a staple, then add other intraday charts of their choice as they develop their own style. Next to the charts, add level 2 screens. Cover the level 2 with a chart if the flashing colors distract you. Then add the New York Stock Exchange and/or NASDAQ tick trend if available, the E-mini S&P futures, and other mini stock index futures if available, and the major market averages. Finish it off with industry indices you're targeting, a watch list of stocks, and perhaps a ticker with those stocks on it. If you have a new service, keep that in a corner of your page. You'll also want a window that opens easily to market research. Your goal is to locate stocks in which top-down criteria and chart and time of day agree. Let's say that this is a fantastic Tuesday morning. Just after 10 a.m., market internals glow with positive numbers. Yesterday, your target stock consolidated into a close near its high. It opened this morning and danced a half point higher, then consolidated into the 9:45 a.m. reversal period. Now, it's making a nice tight edge across your 5-minute chart. The 200-day MA rides way below the current price, and the 200 MA sits just under it. The same setup is developing on the 5-minute chart. Suddenly, you notice buy orders heating up on your time and sell screen. Buy orders eat through the offer like a hot knife through butter. A quick check of your charts show the current volume spike rising. This stock's going to break out any second. You double check the resistance on the 15-minute chart, none to worry about. On the daily chart, you noted earlier that major resistance was more than 4 points away, and that was 2 months ago. You pounce onto the offer. Got it. Buy recorded, stop order entered. The stock noses over resistance. One more click adds to the position. See the stock rising, see the trader smile. Do you understand what I mean about everything coordinating? Yes, that was the perfect scenario. Trader heaven. I've been there, and you will be too. Only experience will teach you how to glance at each reading and weave them all together into a single decision, to enter or to not enter. Please err on the side of caution and avoid trades you're not sure about. If you buy and in the next, second, wish you hadn't, sell immediately. When in doubt, get out. In the next chapter, we'll fine-tune day trading into scalping plays. Then we'll learn why your shorts fall down. All right, cool. That is the end. I looked up and my hair was doing something totally different. All right. Okay, cool. So we have quiz questions for the end of this chapter. Question number 1. What are the first 4 Fibonacci numbers? Number 2. Give one reason traders look to these numbers for guidance. Number 3. Strong stocks in an uptrend tend to bounce off of their blank or blink moving averages. Number 4. Define a gap opening. Number 5, when your target meets your entry criteria but gaps open, how do you play it? Number 6, why do you study your stock's previous intraday pullback range? Number 7, why do you day trade? What is the maximum loss? Backtrack. Number 7, when you day trade, what is the maximum loss you accept? Number 8, true or false? If your stock acts irritated, you're justified in moving your stop order down to a safer place. Number 9, true or false? Odds of morning day trades increase on the long side when the target stock consolidates into the prior day's close and closes near the day's high. Number 10, what's the best overall guidance or guideline for setting stops? Number 11, before you enter a trade, what do you check first on your stock's level 2 screen? Number 12, what is the ideal spread between the bid and the ask? Why? Number 3, with listed stocks, if possible, trade toward blank. Number 14, at the end of this chapter, we pictured a Tuesday morning scene. Please imagine the same scene again. This time, however, a total of 3 negative conditions suddenly crop up. Using everything you have learned so far, what might they be? Hint, any one of the 3 causes you to reconsider the trade. All 3 together cause you to sit on your hands. All right, cool. So that wraps up chapter 10. And we'll go over the answers to the quiz in the very next video. And that's fucking it.
Listen, I told him I'm not girlfriend material, but